All right, are we in for a repeat of how we started last week? We started the week off with a little bit of a sell-off. We talked about the possibility of us filling in some of last week's range towards the lower end before moving up potentially towards the end of the week, and ideally having the sell-off or any selling towards the lower end of last week's range occurring earlier in the week. Well, we got that wish. Today it occurred today. And the nice thing about it, and we'll talk about the extent of the sell-off and what that tells us, as well as a discrepancy in terms of the risk-free trade, the risk aversion trade. I'm going to break that down in today's video too. And then we'll take a look at how we can hedge for any protracted downturn move, but keep the cost of that hedge really small if the market does indeed bounce off support and start a new intermediate run to the upside. So let's go ahead and get started. Today is Monday, August the 12th, 2019. This is the Market Outlook from MarketScholars.com. My name is David Settle. Okay, let's start off taking a look at the S&P 500 with the Market Forecast Indicator. You can see that with the drop we had over the last 2 days, but including today, of course, the near-term line has dropped back down into the reversal zone. Again, usually that first near-term rally into the upper reversal zone isn't the one that lasts very long when you have a new intermediate trend starting. Now that's usually the case when the intermediate line's oversold. The intermediate line never did get below the 20th percentile, but you can see that's been the case so far here. We've got 3 days with the near-term line above 50, and you're already back below it, and you have a bullish intermediate confirmation signal. Now granted, it's not the strongest intermediate confirmation signal because it's we don't have a strong bullish posture, right? We don't even we just don't have a strong bullish posture at all because it's not above 50 yet. That's when it gets above 50, that marks the beginning of a new intermediate run, and we're not quite there yet. You can see the pullback got us back into, after hitting the bottom of the retracement zone of this intermediate rally. We bounced up out of it a couple of days ago, Thursday, and then now bounced back to the midpoint of that intermediate rally. Obviously still above. In fact, it's actually the midpoint of this 2-day rally that we had right here. That was something I tweeted out earlier today here. You can see here on my Twitter account. Again, we pulled back to 50%. You'll see this here in a minute. 50%. As we mentioned in class actually last week, this idea in the technical analysis class that this week's range could be between 287.5 and 297.5. And ideally, you'd want the move to 287.5 to be as early in the week as possible. Again, similar to what we saw this week, right? You want the declines to be, you want the low of the week to be early in the week, not late in the week. So we didn't want the rally to go up here first and then pull back sharply. We wanted to go down first and then rally, if that ends up being the case. And so far that is the case. So again, a lot of the volume here on the decline, 2-day decline, much less than what we saw in the 2-day rally, these 2 days before that. So I pointed that out there, and that was kind of the idea behind what we talked about in technical analysis, and I alluded to in Friday's video when we talked about we could pull back into this range early this week before bouncing up, and that has been the case. Interesting that as bearish as people were today with this little volume, relatively speaking, as you'll see here in a second. Again, the red line is the 23% Fibonacci retracement of this market sentiment run that we, again, market sentiment's falling here, so it's not, but we're still above 50. So this market sentiment run's still not done yet. Obviously, we're below a falling moving average. That's why it's red. But we don't have the dark pink shading. We actually have light green shading. So we'll see if that turns dark pink. Obviously, probably would if we were to break below 28.50, below this retracement zone, where again that support would be. Let's take a look at the Dow Jones Industrial Average. And you can see how it's pulled back again right about to the midpoint of that 2-day rally that we had previously. Still same pattern, right? We have a pullback on the near-term line, an oversold momentum line, in this case an extremely oversold down to below the 10th percentile, and a weak bullish posture. So either we're going to bounce off of this short oversold sentiment, with a new bullish near-term low point, whereas this was a bearish near-term low point, being a lower low into the reversal zone. This would be a bullish near-term low with a slightly higher low, with the low being between the 20th and the 50th percentiles. Of course, the NASDAQ composite looks very similar. The Russell is the one that doesn't look as similar. It's pulled back a little bit more. Its near-term line down. Its near-term line did not get into the upper reversal zone. It's got the weakest bullish posture, and you can see, other than that, similar patterns. You can still get a bullish near-term low out of this. Very weak bullish posture and oversold momentum line. In this case, usually the momentum line does get a lot more oversold, and for that matter, overbought on the Russell 2000 because of its higher beta. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over our logo right here on the bottom right corner of your screen. Hit that red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube itself. Also, while you're down there, hit that thumbs up icon. That tells me two things. Number one, you got something out of the video today. Number two, that you want us to do it again tomorrow. So quick way to give us feedback. If you like these videos, let us know. The only way we see that we get your feedback is through that. So just click that down there. You can do that right now while you're watching. Also, while you're down there, comment. What did you get out of the video today? People come for the first time. Why should they watch it? What are they going to get out of it? So let me and them know down in the comment section below. Join our daily market outlook email list. There's a link up there popping out in the top right corner of your screen. Click on that link to subscribe to that list. Follow me on Twitter for more content in between videos from day to day, and join our market outlook community that we've created on Facebook. Also, if you're watching us on our blog, as you can see our video here embedded in our blog at marketscholars.com, just go to Market Scholars, click on blog there. You can see a few things on here. First of all is our classes. Tomorrow morning, our next class is our dividend growth investing class. Very, very popular class here that Brandon teaches on Tuesdays. In fact, if you want to watch that class tomorrow, you can click on this link to subscribe to our monthly service, which includes a 7-day trial to watch that class, as well as my class later this week on technical analysis. You also get access to all the archives for that class. Down here at the bottom, we invite you to engage with us on social media. That way that you let Twitter and Facebook know that you want them to show you our posts and our tweets at the top of your timelines. The way you do that is you just engage with us, and we try to make it easy for you. Click that heart right there. It opens up this window. Hit the like button. Click that image. It takes you to your Facebook page. You can like today's Market Outlook post from there. Again, you can do that right now while you're watching. All right, now let's get back to the charts here. Let's take a look at the long-term chart, because remember we talked about how last week, depending upon how we finished, we'd start off with a bearish candle here. You see the open was at 29.38, just a shade under 29.39. We were obviously down to 28.83. So now the question is, where do we finish the week? We're going to finish the week up towards that 297 and a half on SPY, which would create that transition candle here. Or are we going to come down here and retest these lows from last week at 28.22? All right, because again, we're about halfway through. So you can see a little bit of a bearish candle. We've seen similar ones before. The question is, are we going to get this by the end of the week? And that's kind of what we need for a bullish turnaround to occur. Otherwise, we might still continue to test this 200-day moving average. See, we took 5 weeks here, or 4 weeks of pulling back towards the 200-day moving average, even going below it a little bit like we did last week. And then we got the transition candle and the new intermediate run. So we'll see if that ends up being the case again this week. Keep in mind, last week we had long lower shadow, and depending upon how things work out this week, we could end up with another relatively longer lower shadow. So remember how bullish those are. But again, one candle patterns like hammers, they need confirmation, which would be the close up above that body up there. So that would be the confirmation that long candle is a reversal. In fact, a reversal. Until then, the support, the low point of that candle can act as a support as you still trade within its range before you close up above it. Let's take a look at the 3 green arrow chart for the S&P 500. You can see, obviously, we still got one green arrow, like the intermediate posture being bullish. The stochastics is as well. The MACD is not quite. So if you take a look at the 2-line versions for this, the MACD is still below its moving average. When it gets above its moving average, it will get a green arrow. It might still be below 0, but it'll be above its moving average. It'll be above its moving average at least. like the stochastics is right now. You can see we're trading below the 8-day moving average. You know, the 8 and 17 are both falling. You kind of need to get above that 8 and stay. See here we had kind of a failed break of the 8-day moving average before riding it down lower. Then we finally closed up above the 17-day, and then that was the reversal, right? So we need to get above the 8 and really get above that 17 before we feel really confident. And that, even that, you can see a few times over here, we got above the 30 and we still were bearish. But getting above the 17 is a good sign that, you know, this reversal is sticking and that we're now moving towards the upside again. So that's something to watch for this week if in fact. Now again, keep in mind, you know, where would we need to trade? Well, 29.0, let's see, 20, the moving average here, let me pop this over. The moving average at that 17 is right now at 29.38. So, you know, that's where the Hakunashi Open is. So we'd have to get above that for us to, you know, indeed it would be, you can see how it would be a transition candle then on the weekly chart if we were to close above that 17-day moving average, because we'd get an upper shadow and a lower shadow on this week's weekly candle. All right, now let's take a look at the intraday chart, and this is kind of what we talked about on Friday, that, you know, we could pull back down into the support because there's very little support because of the gap here and the rise, the quick filling of the gap pretty much early Wednesday or Thursday morning last week. There wasn't a lot of volume in this space, and so it makes a return after hitting this resistance here and makes a move back down towards this 287.5 really easy. Because there's very little volume in the middle of that until you get down to about 287.5, basically the bottom of the gap, where there's more volume now, and there's volume all through here, that it can act as a support level. And of course, you bounce off of this, you're going to face resistance again in the same area, but once you break through that, then you can see how a move to 297.5 is very easy, because there's very little, just the same thing, there's very little volume in that area because of how far and how fast we fell then. Let's take a look at today's volume, and as I showed you on that tweet, you can see how the volume today was a lot lighter, and in fact you can also see how, you know, we didn't hold that Fibonacci fan during this move the first go around, but we are holding it now. So we'll see if this ends up being the support for the week by holding that fan there. But you can see how the volume was very minimal, relatively speaking. If I were to get rid of this MACD and stochastics, you can kind of get a glimpse of the volume and how little it was, relatively speaking. Again, you know, here's the move off of the low point with all the volume it had. Then there was the first decline, and then the, you know, these 2 days of declines relative to these 2 up days. So not nearly as much volume on the pullback, and you can see even the trading range today. I remember, keep in mind that we closed at 291.62. Today's high was 291.61, so a little tiny bit of a gap that we filled in initially and then pulled back down. Again, you can kind of see it here on the intraday chart. You know, a little bit of a gap there, and we never really did get up to the 296 in the regular trading. Of course, in the after hours trading, it's probably where we touched that level. Regardless, you can see how the ranges for the last couple of days were not nearly as big. 3.5 points, 4.5 points. Again, that's on a, you know, depending upon how you're looking at it. You know, 3.5 points is a little bit below the average. 4.5 points is a little bit above the average for where that average is right now, and that average is at a relatively high level, still below this 1.5% mark, which kind of contains the intermediate pullbacks. Breaking through there is when you get the more market sentiment pullbacks, and we're not there yet either. And again, you can see the volatility, the VIX getting above 1. But not getting up to these extreme levels, and definitely not getting to surge levels. So again, as bearish as it seems, you know, we're not seeing the extremes, except for last Monday. We're not seeing the extremes in trading ranges or volumes or volatility that like we saw, for example, last October, you know, where we got such a big surge in volatility, and then volatility stayed at extremes for a while here on the bounce back up. So, you know, we're not near those levels quite yet. And again, today we close at the high of the day for volatility, which is not a very common sight, and usually leads to a pullback. You can see last week, Monday, we also closed at the high of the day. But for the most part, you end up closing at the lows of the day. Or you come off, at the very least, you come off of the highs by the end of the day. So we'll see if that ends up being the case, like last week, for the rest of this week. All right, before we look at what's driving the price action today, let's just kind of pause and summarize the technical outlook, which again, we had a little bit of a bump in volatility today, not nearly as much as we saw last Monday. And it was kind of expected after you bounce off of that low so much last week. We talked about the possibility of this week of getting a range similar to last week, but with the lows of this week occurring hopefully earlier in the week. And as of right now, that looks to be the case, especially with the pullback today. As of right now, closing around the midpoint of of last week's rally, the end of week rally. So we'll see if we get another end of week rally up to new highs off of this, what could be the first bullish near-term low point on this new intermediate run. So we'll see if that ends up being the case. Of course, we still have the possibility of trading towards the lows of this week, last week, that can still act as support. So if there continues to be more volatility, you can kind of get an idea of where that range may be for the broad market as a whole. And of course, breaking through that changes the scenario, which most likely would coincide with that surge in volatility up above the 115% mark. In that case, we're going to be bearish for a while. That the market sentiment line most likely is going to end up coming down below the 50th percentile. And that's going to take a while, a few months, a month or two, similar to what we saw in early 2018 and again at the end of 2018. So what do you think? Do you agree or disagree with that assessment? There's a link popping out right there. It opens up a poll. Then hit either agree or disagree. If you click disagree, scroll down to the bottom on the YouTube channel here and comment. What are you seeing that would suggest otherwise from what we came up with our daily routine here? All right, let's get back to the charts and let's break down the moves that we're seeing this week, today. And you can see these safe haven asset classes continue. In fact, they have, unlike volatility and unlike stocks, which traded towards their extremes of last week, did not trade, towards their extremes of last week. Gold and bonds did. So they have now, in fact, just a little bit higher than last week's, closing above there. Whereas on the other end of the spectrum, you can see the relatively strong dollar. The fact that the dollar is outpacing some of these other asset classes, you can see, is really pressured emerging markets. Emerging markets, are down 7%, and a lot of this week's weakness occurred with what's going on overseas, especially in Hong Kong, and the impact that that's had on investor sentiment and that particular economy, that particular segment of the Chinese economy over there in Hong Kong. I did want to bring up this idea again. You can see TLT, how being outside of that first standard deviation or second standard deviation channel still, gold as well, being outside of that second standard deviation channel. You can see the VIX is not nearly as bullish, and so I did want to kind of share with you this December 24th level. If I were to go back here on this custom time frame. And go back to 1224. 1225 of 2017, and then we'll culminate this with 1224. That was that peak there in volatility. So the difference between what we're seeing right now is, the VIX did jump out of this upper reversal zone, and even on this initial surge that we got here, which is 1011. If I were to go back to that custom here and look at the 1 year time frame for 1011 on that initial surge of volatility. So again, a 1 year chart, you can see how bullish it got. On that, again, that surge up to the 125% mark. In fact, I think was that what that mark was? Let's see here on the daily chart. It was, yes, on 1011, got up to that level. And of course, you saw how bullish it was on December the 24th, right? So here's what the S&P 500 looked like, and again, there's December the 11th right here. That was the initial surge to the downside that we knew we were going to be bearish for a little bit longer. So here's that the S&P 500 on December the 24th. This is long-term bonds. So even though it was on a downward trend, it was still at a peak, especially with the spike in volume that it had outside the second standard deviation channel. And then you can see what gold did. Gold also spike in volume here with a surge outside the second standard deviation channel, even though we were on a decline. So, we're seeing very similar moves to safe havens, extreme moves to safe havens. I would even argue now that the current moves to safe havens are more extreme than those because we're on an upward trend and they're more parabolic here, especially on TLT. All right. So you can see how extreme they are and how big the ATR is, the volatility for the volatility. In fact, if I were to look at, well, let's just go here. The volatility is similar to what we saw in early 2018. We've seen how the ATR can get really big on some of these moves, either to the downside or to the upside. So we're getting a big spike in volatility, and we're comparing to December the 24th, December the 24th of 2018. That's how big the spike in volatility got then. So it kind of keeps gives you an idea of just how extreme we are now. But we are outside that third standard deviation channel on both long-term bonds and gold. In fact, if you were to go to the 5-year chart, we are outside of the second standard deviation channel on bonds and gold. So again, that's not the case with volatility, and it's not we're not to the extremely oversold on stocks to this level. So for us to be that extreme, I mean, if stocks were to pull back, the investors, according to those charts, investors are already in these safe havens. So if stocks were to pull back, where is that money going to go to? You have some very overvalued safe haven asset classes, and not just obviously not just bonds and gold, but you can see a real estate sector as bullish as it is, and the utility sector, which isn't very extreme. You can see it's riding along the first standard deviation channel, which is kind of its mark of how bullish it gets. And of course, staples have run up to that first standard deviation channel over the last few weeks. So it's been a very bullish safe haven trade, even though stocks themselves haven't been nearly as bearish as other times that we've noticed the safe haven trade being this bullish. In fact, again, the last time it's been this bullish being at the end of December. So kind of gives you an idea. I mean, we go back to, even to October the 29th, when we really had this was a 4 standard deviation move from October the 3rd at the volatility levels all the way to the end of October. That was a really bearish month. And you can see how it brought the S&P 500 down, in that 4 standard deviation move all the way down, just like that, to the second standard deviation channel to the downside. And we keep pushing it down. But if you look there was plenty of room for safe haven trades like gold to make a run up to its second standard deviation channel. There was plenty of room for TLT to make a run up towards its second standard deviation channel. And they eventually did at the end of December, but they weren't anywhere close on that initial October surge where we started, from the declines in October and then made its way by the end of the month down to those kind of that initial first lower level on stocks. You can see again here what it looks like right here on October the 29th right there. So that initially set the bottom, but you can see like the safe haven trade wasn't overbought in the least bit. In fact, you could say it was somewhat oversold still. And so it had a lot more room to run. And eventually they did get overbought by the time we got to the end of December and the market rallied. Well, again, here, with stocks not being nearly as oversold as they were in October, those safe haven trades are already overbought. So to me, that tells me the market got a little ahead of itself in terms of preparing for the worst. And usually those kind of extremes like that or signify that that we might not be nearly as bearish as the market thinks that those particular markets think we are, to those extremes. All right, let's take a look at how the sectors performed, and you can see how stocks are still almost down 5% for this 2-week period. And just like on the asset class comparison chart, you have your safe haven sector still leading the way higher. I did want to briefly bring up, I didn't bring this up before, but the foreign stocks and how they performed today. And just look at today only. So let's bring it down to October the 12th here and look at an intraday chart. There's the S&P 500. There we go. You can see the S&P 500 down with China, down 1.25%. You can see what some of these others are doing. Let's zoom out to the 2-week time frame again and see, who's how they're performing over the last 2 weeks. And again, it's like S&P 500 is down, but it's all relative, right? It's Japan and Canada, of all the major economies out there, the biggest companies in those areas are the only ones outperforming the U.S. Everybody else, from Germany to Russia to Brazil to China to the U.K., are all down 5%, down all the way up to almost 9% in this 2-week period. So, when you consider how bearish we've been, put that in context to what the alternatives are, from an equity standpoint at least. Back to the sectors, and you can see the safe haven area is still doing very well with how bullish bonds were. Utilities and real estate continuing to significantly outperform. On the other end of the spectrum, of course, the other interest rate sensitive area is financials to the other degree, and they're just struggling big time. And you can see also other cyclical areas, technology, discretionary materials, industrials, all lagging behind and dragging the S&P lower. With all your safe haven areas, communication services, remember, has an element of utilities to it. And so it's outperforming too. And then, of course, the energy stocks with a slight outperformance by the end of the day. They were down the most at the beginning of the day, and they rallied and outpaced by a small margin by the end of the day. All right, well, let's go ahead and take a look at our trade idea of the day. And as you can see, we got First Solar up here. It's a stock that's been on a really good bullish run for most of this calendar year, coming off of that low point. In fact, going from $40 just under up to all the way up to 70. So nearly a 100% return. As you can see, even the year-to-date still at 43.5% after the little bit of a bounce we had off of that December low point. So about 39, so not quite 100%, but 39. Closing there on Christmas Eve, and then getting up to a high of almost pretty much getting up to 67. So a pretty decent return. But now you got that bearish pattern, right? You have the dark red line, you have dark pink shading on the market forecast, you have strong short oversold momentum line with a falling intermediate line and now falling market sentiment, which had been gradually falling as it is, as we've been rallying. It's been kind of diverging up to the upside, but now things, appearing to be getting a little bit more bearish. And you think, okay, well, if the markets don't hold this support, if we do get more bearish, is there a way that we can manage risk to a small loss if we do bounce, and if we don't bounce, we can get a good hedge onto the downside. So we'll talk about how to do that with a stock like this. I mean, from a long-term perspective, you can see it's been a great long-term story. But you can see now we're on a kind of a bearish turn. We had this good little rally. We're now down below the 50. We closed below the 50-day moving average. We're looking like we're at least starting to fill in the gap here down towards that 200-day moving average. With this falling long-term, this falling momentum line starting to roll over as the gap between the 50 and the 200-day start to shrink. If you look at the three green arrow chart, you can see that we got 3 red arrows here, and then we broke down on the earnings, and then we broke down further here last week, and then now we're kind of this dead cat bounce, or we broke down, we bounced up, and now we're headed lower on this potential dead cat bounce. And again, if it bounces and the market bounces and holds, then we can keep losses small, right? But the rest of the portfolio being as bullish as it is, generally speaking, for most people, when you're looking at especially your passive portfolios. But if it does break down, can we hedge with it? And again, you can, if you look at like the Bollinger Bands, just to kind of show how far, you've got some support in this area. If we were to break down, you can see a move to 55 would not be out of the realm of possibility at all. In fact, there's not very much room down here at all to work. I mean, from a volume standpoint, it's a big vacuum that can be easily filled with a move towards 55 down into this 52.25 range before it finds significant levels. You can see, here's, you got some trading and some lows here, but very, very little volume compared to how much volume we've had above it and below that level. So that's why it's not as strong as a support as you might think it is. You look at the DMI for FSLR, and you can see, the orange line is crossed up above 25 again with the breakdown today, and the blue line is already below 20 with rising ADX, which means the trend is strengthening. It's not above 20 yet, but it's starting to work its way up towards this 15 level, and again signifying a strengthening trend, at which, again bring up the Ichimoku cloud first, and you can see how we've broken through to the other side of the cloud. And then you look at the trend strength indicators as a whole. Oops, nope, don't want to delete it. I want to look at it. So let's take a look at it here. And you can see on a weekly basis, it's still a bullish trend. So that's how much potential we have to the downside. But on a daily chart, you can see now that we're losing that bullish trend, and now potentially reversing back to the other, at least according to the DMI, starting to reverse back to the other direction. So how can we trade that? Well, we can look, again, you can see, remember 55, actually 52.5 is where that support is. And you can see that this can go, according to current volatility levels, and just within a 1 standard deviation move, it can get down to 53, much less a 2 standard deviation or more, which is what you typically get during the declines. So if we were to say sell this 55 put and buy the 57.5, so go out of the money below the 40 deltas, go cheap and buy the 55. Now I've got a really cheap vertical spread. I mean, $60. And if I risk half of that, with a really relatively low delta, as you can see, the delta is smaller than, say, buying a put at only a -10 delta, and the gamma is positive, and it will be positive until you cross through into this threshold where you'll have a positive theta, and right now, which is a very small negative theta. And if Vega rises, volatility rises, then we'll get a benefit out of that. Right now, we'll get a benefit out of that as well. So this is basically a way to do a kind of a put trade without the problems of the negative theta that really kind of weighs you down if the trade doesn't work out. And again, $30, if you end up taking a $30 loss out of the $60 max, and it would take a pretty significant move to the upside just to get the 30 out of that 60 because of how low the delta is, then you've got the room for it to run, and you compare $190 to a $30 loss, and you've got a good 6-to-1 reward to risk ratio plus on that. So again, it's a small risk if it goes up, depending upon what your typical risk management is. Considering the speculative nature, you probably would cut this in half of what at least in half of what you normally do on any trade, where you're kind of following the trend, so to speak, and following the market and all of that, kind of a top-down approach. So you'd probably do a smaller trade than normal, and then, like I said, the reward, if it does work out, will end up being a pretty decent hedge for the little risk you get. And if the market does bounce back up, then the benefit of, typically most of your portfolios are probably pretty bullish, especially your passive portions. Your active portions might be getting less bullish, but your passive portions, they probably are pretty bullish to the upside. So you take a small risk, insurance policy cost to the upside, but a decent reward for a hedge to the downside if we do pull back. And here's an example of one way of how you can do that. All right, so that wraps us up for today. As always, thank you very much for watching. You've heard from me. Now I want to hear from you. Let's use that link right there popping out in the top right corner of your screen. It takes you to our Market Outlook forums. All you have to do is be a free subscriber to participate in those forums, but you can be able to interact with other market scholars that watch these videos and ask questions and comments, and you ask me questions as well. Again, thank you for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment down on our video below, join our email list that we have, follow me on Twitter, and join our community on Facebook. Have a great rest of your evening, everybody, and we'll see you all next time.